Well, U.S. President Joe Biden signing a law Wednesday that would ban TikTok if its China-based parent company doesn't sell. Here's money expert Rubina Ahmed-Haq. She joins us now for more. Rubina, good morning. And what sort of financial impact do we think a TikTok ban across America would have on users, particularly companies and influencers who truly rely on it?
So this would have a huge impact. A TikTok among young people, so 30 and under, is the most widely used social media platform. Facebook is by and large the most widely used amongst everybody, but among young people, it's TikTok. And so a lot of influencers have built their brands and built a following on this platform, and it brings them some very big amounts of income from sponsors, from partnerships. So this could have a huge impact on them. I'm sure they're watching this and thinking, should I be switching to another platform? But it may not have the audience that they need in order to sell the products and brands that they partner with. They have not up to 9 months now to see what's going to be happening with TikTok. But I think that this is just another cautionary tale that when you're building your brand on a platform that you cannot control, so all social media platforms would be in this, that you need to build in some security that if they change the algorithm or the rules change, that you still have a way to make income.
Another headline we wanted to ask you about, Rubina, is this one. The Canadian Medical Association is urging the federal government to reconsider its just announced capital gains tax hike. Why is the CMA arguing that hike will have a negative effect on physician recruitment and retention?
So it's going to take more money out of their profits, and so that will give them less ability to hire, to scale, to see more patients, because more money will be going towards taxes. So this new capital gains tax, when it comes to corporations, is from $1. They are going to be charged on 2/3 of the income that they make, so the gain that they make. And so it could vary from year to year, but they're saying that what this really is going to do in an immediate way is going to force them to save more money for their own retirement, their own time when they leave work, because they'll need more, because eventually when they leave that corporation, it's going to be a massive hit on them that they did not expect. And then on top of that, as their ongoing business, they will have to pay more tax, and that means that they can't hire as many people and maybe not see as many patients.
And over and above that, Rubina, there seems to be a lot of confusion surrounding this capital gains hike. I was just reading yesterday that the real estate market's being flooded by people rushing to sell their cottages in particular before this hike takes effect. The finance minister, Chrystia Freeland, has called these changes, quote, really fair. Can you explain for us exactly how this works, how it might impact Canadians?
So this is for individual filers, so not corporations. So someone like you and I that would maybe own an investment somewhere and then they would sell it. So say you own an investment property and you're nearing retirement and you want to sell that retirement and use that money to fund your years after you stop working. Say you have a gain on it of $500,000. Now, previously, 50% of that would be subject to capital gains, which would be taxed at your marginal tax rate, whatever that is that year. Now, what Ottawa is saying is that after $250,000, after that, so say you take that same $500,000 example, 250 of it will be 50% of it will be subject to your marginal tax rate, but after that, 2/3 of that money will be subject to your marginal tax rate. So at that point, you are at the highest tax rate, so you are going to be paying 53.3% income tax on those capital gains after that $250,000 mark, even before that. And so this is really frustrating for individuals who do have cottages that wanted to sell, maybe use that money to do other things with, maybe invest it somewhere else, because now it is really going to take money out of their pockets that they had expected that they would get when they finally sold this property, knowing that they have to pay capital gains, but didn't realize they'd have to pay this increased capital gains after the rules change on June 25th.
Okay. Rubina, finally, Ikea announced yesterday that they have cut prices on 800 items in April. What's behind all the reductions, and is this a sign that inflation is finally easing?
So it is a sign that inflation is easing, especially on furniture. So IKEA says that they're doing it because they recognize that life is really expensive and they want to make items more affordable for Canadians. And IKEA has always been known as a furniture brand that is much more affordable than many other furniture brands that you may visit. The other part of it is that StatsCan is showing that people are buying less and less furniture. Year over year, furniture sales were the price of furniture was up only 0.3%. So IKEA also recognizes that they need to cut prices to get people through the door, because during the pandemic, maybe we did all our renovations and we bought all the furniture that we wanted to buy. Now we're back, to regular life, and we may not be as concerned about updating that furniture in our home. And they want to get those customers back. And how do you do it? You cut prices and get people back through the door.
All right. A lot of workers busy at IKEA everywhere, just changing the prices.
Smashing.
That's a lot of price tags to change.
Yes.
800. Yeah.
Yeah.
All right. Rubina, thanks so much. Appreciate it. As always, good to see you this morning.
Yeah. Thanks for having me.